the banks stopped lending money, all of that stuff. And it meant that all assets went down. And crypto goes down the most because it's the kind of longest duration, highest risk asset. So in June, we spoke in the aftermath of that. That was basically the blowing up of the liquidity cycle.
With each passing moment, Powell's chilling prophecy gains momentum, unveiling a dark underbelly of the financial world where liquidity becomes a double-edged sword, capable of propelling economies to dizzying heights or plunging them into the depths of despair with unparalleled ferocity.
So my general view is, from the work that we do at GMI, I think the market's priced in, and I've talked about this many times, a recession last year. So the year-on-year rate of change, I'll show the chart later, of the NASDAQ got down to expecting the ISM to get to 37, deep recession.
Against the backdrop of a volatile landscape, Powell's words resonate like a haunting melody, cautioning investors of the treacherous path ahead as the wild liquidity game unfolds, luring unsuspecting participants into a dangerous dance with the unknown.
You can either raise taxes, which they're trying to do too, but they're also printing currency via the mechanism called quantitative easing, which is actually debasing the currency, which means that every time they do it, asset prices optically rise. They don't actually rise.
In the realm of high stakes and soaring ambition, Powell's thunderous warning reverberates, piercing through the euphoria of market exuberance as he unravels a sobering truth. The wild liquidity game is a treacherous arena where fortunes are gambled and the unwary are mercilessly consumed.
Firstly, the central banks are taking liquidity out of the system and have been for a while. That has hit all assets. And so crypto down 75%, much like many technology stocks are around down about the same. So that's been going on. That's been putting the market under pressure.
As the intoxicating allure of liquidity engulfs the financial ecosystem, Powell's ominous proclamation stands as a beacon of caution, highlighting the inherent risks that lie beneath the surface, where the rules are ever-changing, and the consequences of missteps are dire.
Why is this happening? All the major governments got to 100% of GDP in debt, except Japan, which is 260, whatever it is. So when they get to 100% of GDP in debt, most of their private sectors are about 100% of GDP in debt, more or less. So if interest rates are at 2% and GDP is growing at 2%, I think of GDP growth as your income to service your debts.
In a world governed by liquidity's whims, Powell's voice cuts through the noise, sounding an alarm that cannot be ignored, as he warns of a dangerous game where fortunes are inflated and shattered, leaving behind a trail of shattered dreams and shattered lives.
If you look at the central bank balance sheet and divide all assets by it, so you're changing the denominator, it's normally US dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars. Now, how many dollars are in the economy or excess printed? And what you find is something like the S&P 500 has gone nowhere. Real estate, gold, gone nowhere. At the same time, when you get to the bottom of the liquidity cycle, if you think about it, if you think there's a bunch of people in the street saying, hey, buddy, can you lend me $1? And you've only got $5 and there's 10 people asking, well, 5 people aren't going to get it. And that's what happened to the bottom of the liquidity cycle. Here's the chart that I've not shown anybody yet. This is the Fed balance sheet versus the interest payments leading by 36 months. And this goes back all the way back to the beginning of QE, and it's amazing. Now, it's suggesting now should be in the, obviously we had this little spike from the banking issue. Now it suggests that it should be slowing down in its rate of change and eventually starts going up in Q3. Let's see, right? We've never used this before as a forecasting tool, but the correlation between this and the longer term version of this was pretty staggering. It's like, holy shit, it's just 36 months delayed payments is coming on the balance sheet. So that's the big hypothesis. So there's the weekly liquidity outright versus the NASDAQ, which is the one that you'll suggest, okay, this is probably rolling over. Maybe the TGA sucks from this. We don't know yet, but look, it's not going up, but the NASDAQ is. So that's got a lot of people saying, well, it's decoupling from liquidity. However, back in 2018-19, when the Fed stopped, it completely decoupled from liquidity then. This is this beach ball effect. So I'm like, okay, that's not unreasonable. I get it. And the year-on-year rate of change of liquidity and the NASDAQ is consistent. So I'm like, yeah, that's fine. I can see why the NASDAQ could outperform at this point. Crypto in 2019 at its peak was up to 300% and then came back being down 100%. It pulled back for most of the back end of the year. So it's like, okay, fine. We can see that as animal spirits come back in, the year-on-year rate of change of liquidity. So I've been looking at that the NASDAQ is outperforming liquidity. This financial conditions index was the thing that gave us a 9-month lead where we think we are on the business cycle. Look, the world is driven, this whole space is driven by liquidity and network adoption. So the adoption of blockchain technology is ongoing and relentless, but the liquidity of how much money's around drives the space. So once you understand that, you understand a lot about the space. So last year was a massive withdrawal of liquidity. All the money came out, the central banks were tightening rates, all the banks stopped lending money, all of that stuff. And it meant that all assets went down. And crypto goes down the most because it's the kind of longest duration, highest risk asset. So where are we now? So here we are right near the end of the rate hikes. The economy is probably going into recession and pretty soon. And so what happens is the markets start to look forward and say, maybe they'll stop tightening liquidity and take the foot off our necks. And maybe things, because our job in financial markets, particularly in macro, is to live in the future. Looking around today is useless. But looking around, what is the world going to look like in 6 months' time? Are the Fed raising rates in 6 months' time? Almost a 0% chance. Because inflation has peaked, growth is falling, we're going into recession. Normally, they would cut rates at that point. Now, they might be a little bit slow to do that because they really, really want to see inflation lower. But it means that the rate of change of all these rate hikes and all this bad news starts slowing down. Which is why we all feel like even though stocks are going up and our 401k is going up, nobody's getting any richer. Okay? We all know this intuitively, that we're not actually getting richer because the stocks I sell doesn't buy me more of a house. So what was the point of buying the stocks? The value of my assets aren't going up. But that is a mutualization, which is bad because it mutualizes it amongst people who don't have assets. So you'll never be able to buy an asset, which is why when you speak to a millennial now, they're like, we can't afford a house. Why? Because they came in to the labor force after the Fed started monetizing or lowering the value of the denominator. So property's got more and more expensive for them. It's impossible for them to buy property really, unless they're really lucky in the workforce or in entrepreneurship or whatever it is. But generally speaking, it's become impossible. And everything has got more and more expensive, assets have, because of this optical illusion. But wages haven't gone up, remember, right? That's the key thing. Assets are going like this. We were doing this before because of demographics and it was making people pissed. And now we're doing it from debasement and there's no way around it. So what debasement does, on the other hand, remember, it makes the price of assets look like it's going up. This is why you can't have a banking crisis of the order of magnitude that existed before 2008. The reason being is you just print money the moment you see it, and voila, everything goes up. So the value of your collateral, so if you think about a debt, it's collateral plus the debt, and the collateral is what guarantees the debt. If you've got a banking crisis, your collateral is often falling so fast that, like commercial real estate, right? We're going to have a problem with that. Meanwhile, China's been leading this. The Chinese economy seems to be a year ahead of everybody else's right now. And they started some stimulus process before their lockdowns. And now they've really started to stimulate because, they'd shut down their economy. So we're already seeing this global money supply, and people can see me post this on Twitter from time to time, global money supply year on year and Bitcoin price year on year. They mirror each other. So when liquidity starts to come back in the system, prices start to rise again. So in June, we spoke in the aftermath of that. That was basically the blowing up of the liquidity cycle. Suddenly you find out that all of the people who were running leverage in crypto were getting blown up, and they couldn't get any money from borrowers, or they couldn't get any money, from investors. And so that had this huge ramification. So June was actually worse than now, because pretty much it triggered everything.
Do you think though psychologically? Because right now I feel like the biggest.
Oh no! Right now, this is the. I'll come on to this in a sec, but yes. So June was the actual damage, right? That was basically the nuke button to say, leverage and crypto, as we've always talked about, don't go together, right? So that blew up, massive balance sheets, Three Arrows Capital, all of them. But one of them was hidden, and we didn't know, and that was Alameda. We knew they were a massive shop. We knew they were kind of a bit sketchy, but they kind of said it's fine, but they weren't fine. So at that point, they were probably $9 billion in the hole, which is a staggering amount of money. Now, we don't know the exact numbers yet, and we won't do for a long time, but there were a staggering amount of money in the hole. And that was papered over by FTX.
When you say papered over, what does that mean?
They gave them FTT tokens, which is the token that is part of the FTX ecosystem that they control and Alameda control, and then gave them a loan against it. That's what it first appeared, but the plot's thickened a lot since then. But so basically they actually went up under in June. So what we're seeing now is the end of the June thing. It was the bit that didn't happen that did happen. So whether this is the exact match dates or whatever, but it suggests we've got one more blast lower below, let's say 45, before we start basing. Now, as you know, the economy actually, GDP comes out a quarter later. So, you wouldn't see these numbers, and you won't come out of a recession, even though it looks like it's very V-shaped from this. It suggests that, obviously, I think there's a lot of slowness to growth to come out of commercial real estate, the banking issues, a whole bunch of stuff. Meanwhile, all we're saying is forward-looking, our financial conditions suggest, okay, things are on the rise, and this leads the Goldman one by about 6 months or so as well, or 9 months. And that's what gave us this view on the NASDAQ, is the NASDAQ had priced for us 37 in the ISM.
Mm-hmm.
So that was like, okay, interesting. And that was where we thought from the financial conditions index, the ISM could go. So I'm like, okay, it seems fully priced. And most of the other asset prices were doing that as well. So that's where we got to roughly with our thinking with this. And that helped us get long at the right time. The other liquidity cycle we've used, just simply because it seems to be a better fit on the year-on-year basis, is Global M2 seems to work very well for Bitcoin. And that turned higher. Obviously, we know the Chinese have been increasing M2. I don't know where it is, 12.5% or so right now. And that's dragging this cycle higher. And I think probably Global M2 goes higher. So again, not looking for the wiggles here, looking for direction. We've probably got a M2 cycle at play globally. So whichever major countries that's a part of, and that should drive crypto. The other one I found really interesting, and I think I'm the first person to have found this one. Here's the ETH Bitcoin cross. Now, this will make sense to you. You're a financial markets guy. Stuff like junk bonds work out well from the bottom of the cycle upwards because they're riskier. My hypothesis is that, okay, this is very observable. I think it's going to last, this relationship between assets and the central bank balance sheet because of the mechanism of debasement of currency. And I can forecast out what the business cycle looks like. And I also know the amount of interest payments that need to be made because they happened 3.5 years ago. And I can see how far the balance sheet's going to expand. So the balance sheet right now is $6.5 trillion. And it looks like it will get $7 trillion or so. And it looks like it will get to $12 to $14 trillion by the end of 2025. So that puts, and there's a number of other ways I've proven this out in this whole thing. And I'll send you the whole piece myself. I've not really gone public with all of the whole thing of how it works. But in the end, that puts asset prices massively higher than here, hugely higher. So we're looking at more than a doubling of the NASDAQ from here. Ooh. We're looking at another gigantic crypto run. That's into 2025. So we're seeing huge moves that just come from the debasement. And I've gone through in the Everything Code article that I wrote for Global Macro Investor, which is my kind of premium research service. In that, I've gone through various ways of proving this all out. So that's what I think I can do. But your observation, I think, is really important. Okay, when people, I mean, I've sent this to quite a few people, and obviously the subscribers of Global Macro Investor are kind of the world's most famous hedge fund managers, asset managers. And I think it really shocked people and resonated with people. They're like, oh my God, everything makes sense now. And so once you see it, it all makes sense. Now, as it becomes more public as a thesis, and Mike Howell at Cross Border Capital has been talking some elements of this, liquidity, you can see liquidity becoming part of the conversation on financial Twitter and stuff now.